There's a company out there called IPD. IPD is an institutional company that collects data on real estate transactions between pension funds and private investors through maybe a dozen different countries. And in Canada, they have a database. We're actually part of that database. And we compared their results over the last 10 years to the actual marketplace that's driven by REITs. Now, first off, I have absolutely nothing against REITs, and we have REITs in one of our pools, and they've done very well. But the issue really is this. The REITs buy the same quality real estate that the institutional investors buy, so the underlying investment is exactly the same. The price and the returns and how they're paid are not the same. So for example, in the best year, in the last 10 years, privately held real estate has risen 17% measured by transactions, and the best return for REITs in a single year is 50%. In the worst year, it was -2 for actual real estate, -42% for REITs, even though we're talking about the same real estate. Why would that be? It's the same real estate. It's because public behavior can affect the price of a REIT because it can be bought and sold every day really easily. Public behavior doesn't affect how institutions buy and trade real estate amongst themselves. So the difference is that the 10-year rates of return are very close to each other, but the volatility is a fraction. So if you want to buy an investment where you're not likely to get shaken out by what happens in markets, it's far better to buy the actual real estate than to use REITs as a proxy for them, because it improves the behavior. And if we take a look at the impact of rents on real estate, going back to a much further, 30 years ago, we put $100,000, the price of the real estate would grow by $167,000, but the total return would be over $1 million. In the case of real estate, even more than with stocks, 85% of the return over the last 30 years has been driven by the rents. So when we're looking at real estate, we care about the net cash flow. And here's some examples. We have three LPs, but two that have been around a long time. One in Canada called SPIRE LP, which is a long-term return of just under 10%. And last year was about 8.4. And then a US equivalent. They're both about the same size. These are income-producing limited partnerships in real estate. They own different kinds of assets. And I'll give you some example of what the assets are like in each of the LPs, and also what we look for. So starting with the Canadian LP, SPIRE LP, this is a property we bought and closed on about 2 months ago. We're just finalizing the financing now. The long and the short of it is, it's an industrial property, it's in Toronto, we like the area and we like the tenants. The main thing that's important to look at is what's in the yellow. It has an income of 6.5%, and we are getting a mortgage at 2.97% for 7 years. As long as we can get more than 2 to 2.5% difference between the income on a property and the mortgage, we're going to make a very good positive return. In this case, the difference is about 3.5% a year. This is another asset that we were buying with our partners that we work with in the US, multifamily. We like multifamily. It's lower risk than most of the other real estate asset classes. This yield is lower, which is what you'd expect in multifamily at 5%, but the total IRR is expected to be 13% almost, because of the fact that this is a property that can be upgraded and the rents will rise faster than inflation over the next 5 years. And finally, we have a development fund, which is quite small, and we've just started it. It actually opened in December. One of the partners we're working with is redeveloping a property at 22 East 5th Avenue. It's really refurbishing an existing building. And I won't go through a ton of details. This is a much higher risk investment because it's not liquid. And typically these returns are earned over about a 3 or 4 year time frame. But the projected IRRs are much higher. So for somebody who has an appetite for this, that is a very reasonable rate of return in this environment. So in my case, my decision was to take 10% of my allocation that I'm putting into real estate and be comfortable having the risk of having it in this particular space. So in the past, I've talked about asset allocation, and I know David really covered this well at the beginning. I wanted to share with you an update on a group that you may have heard of before called Tiger 21. Essentially, they are retired business owners. To be in this club, you're supposed to have 10 million of investable assets or more, and they are looking for independent advice. They publish their asset allocation model, and it looks like this. Much different than you see in a typical balanced mutual fund. In fact, approximately 44% of their allocation is to private equity and real estate, only 23% to public markets. So this is maybe a bit more extreme than you would see on the institutional side, but basically the message is the same. There are a lot of other asset classes out there that complement being in publicly traded securities. And I wanted to sort of frame this asset allocation with an interesting metaphor. Now, as you can see, these are ingredients for cooking something, and I got to tell you, honestly, I'm not the world's greatest cook, but one thing I can make is arugula pesto pasta. It's one of three things that I can make, actually. And the reason I'm mentioning this is that when the meal is finished, when the dish is cooked, it tastes delicious. Well, maybe not every time I make it, but if somebody knew what they were doing, it would taste great. I just want you to imagine what it would taste like, though, if you just ate each of the ingredients raw before they were cooked. Now, in theory, the ingredients are still the same in both cases, but the difference is, Aristotle says, the whole is greater than the sum of its parts. That's what asset allocation does. It actually gives you the ability to generate a far better rate of return than you would normally expect given the risk that you're taking. So I thought I'd try to demonstrate that. This is our typical balanced portfolio that we generate for clients. You can see there's an allocation of about 18% for real estate. There's about 35% in fixed income in a variety of categories. And there's about 32% in equities, and that's typical for us. And we're not market timing here in any way. And about 12% in alternative strategies, and that includes allocations to private equity as well. So let's take a look. Let's imagine that as the alternative, we had defaulted to a typical balanced portfolio for the last 10 years of 60% stocks, some global, some Canadian, and 40% in fixed income. What we would have seen as a result in returns over the last 10 years is 4.8% net of fees. We would have seen a volatility. The higher this number is, the greater the risk you're taking, of 8.1%. And the worst year we would have experienced, which would have been 2008, would have been minus 13.4%. If we just invested in the TSX, we're going to take more risk, but we would expect a better return. And there is a better return at 6.4%. It's a third better. But the volatility is more than double, which is what you would expect with equities only. And the worst drawdown is 34%. It is significantly greater. So the question you have to ask yourself is, how much can you stomach in the way of the volatility of this kind of portfolio? The core portfolio that we talk about, our core balanced portfolio, in the same time frame has earned a market, like an equity market type of return of 6.2%, with 1/3 the volatility of equities, less volatility than a typical balanced fund, and a much lower drawdown compared to both of them. So yes, it's both the diversification and the focus on cash flow that allows these outcomes to occur. And there's no reason that we think that that will change dramatically over the next 5 or 10 years. So the right asset allocation, well managed, can reduce and increase returns, and that in turn can reduce volatility and change investor behavior. So that's sort of the message that we wanted to close with today. I want to first thank all of you for coming tonight. Just a reminder that if you're in Toronto or know people in Toronto that would like to attend this seminar, we're doing it in May 7th there. Rob and David and I are going to hang around for some questions in about 2 or 3 minutes, but we thought the rest of you might like to go out and refill that glass of wine or see if there's any food left. I'm sure there would be. So may I thank you all for coming tonight and look forward to seeing you outside.